Well, thank you very much. It's a great pleasure to be back here in Hayes. It's a pleasure to see everybody's faces this year. Last year we were all masked, and so it's nice to be able to come together. It's such a beautiful facility. This year we thought we'd switch things up, and instead of just me talking about our housing forecast, we wanted to bring in some local experts. So I'm going to set things up here real quick, and then I'm going to talk very short, and then we'll hear what the locals have to say about the market. So before I begin, I do need to give a big thanks. We are able to put together our annual housing forecast because we have agreements with all of the MLS boards and realtor boards across the state, including the Hayes Board of Realtors. And through that, we have access to home sales activity, which is really helpful for the work that we do. But in partnership with that, then we actually provide back to the local boards monthly statistical reports that summarize the activity, and that's a service that we're able to provide, and that's through a partnership with the Kansas Association of Realtors. So we're grateful for that. When I do our annual housing forecast, I always look at two fundamental elements. One is the labor market, and Jeremy's talked about what's been going on there. And then the other is the mortgage market. What does it cost to get mortgage loans, and how accessible are they? And the mortgage rates that we've been at right now are just incredibly low. We've been bouncing around 3% for a 30-year fixed rate mortgage. And that's, I mean, when we were sitting around 4%, I said this just isn't sustainable. We can't go any lower. And as soon as an economist says something, it's going to not happen, right? And so rates continued down. The line that I really wanted to highlight here was the orange line, which is the Mortgage Bankers Association's forecast. And they actually just released a new one here late last week, and I didn't get a chance to update the slide. They're now predicting that by the end of 2022, the 30-year fixed mortgage rate will be below 4% still. Their forecast through the end of 2023 is to around 4.1, 4.2%. So very, very slow, modest growth. That's actually about the point that they forecast back in 2019 when you saw that rates were just below 4%. Their low fours seems to be the level at which they're saying this is where we think long-term mortgage rates are going to settle out. That's at the bottom end of my belief of what is a reasonable range of mortgage rates when we have a world where we have good, solid economic growth, low inflation, and no extraordinary activity that's going on. And right now, what's really driving the low mortgage rates is the extreme purchases of mortgage-backed securities by the Federal Reserve. And so if we get back to, and we haven't been there since 2007 or so, if we get back to something that's a more normal market, I think mortgage rates have to settle out somewhere in the 4.5% to 7% range. That would be consistent with solid economic growth, be able to provide investors a reasonable rate of return, real return plus risk for holding mortgages, and protection against inflation, an inflation premium. Anything above that, I think that's really reflecting probably beginning to have accelerating inflation. Anything below that reflects either very slow economic growth or it reflects extraordinary intervention in the markets. So that's my view, and we'll talk about that and ask how our participants here will think about that. As context, this is what's been happening in the Hayes housing market over the last 10 years or so. And the pink bars are the actual home sales reported by the Hayes MLS every single month. And then the blue line is a moving average that gives you a sense of the underlying trends when you get past the seasonality. And what we can see here is after increasing pretty steadily for about 3 years, home sales have tailed off over the course of this year. And I think year to date right now, we're about 16% down compared to where we were in 2020. Excuse me. one of the reasons and issues, or a question that I'll pose to our panelists, is that as we've seen home sales activity decline, we've simultaneously seen the inventory of homes available for sale drop dramatically. This number is a number that we call months supply. And what we do is we take the number of homes that are actively listed on the market and we divide it by the average monthly pace of sales over the past year. So if you had 100 homes available for sale in your local market and you were averaging selling 20 homes a month, then you would take 100 divided by 20. You would have a 5-month supply of homes available. We normally think of a balanced market as being a market where we have between a 4 and 6 month supply. Now that can vary by local markets, but generally speaking across the state, then you can see we haven't had a balanced market since 2015. And we have steadily gotten into tighter and tighter inventories, where now across the state on average we have around a 1-month supply, which is just incredibly tight. I have some realtor friends who will say, we don't have a month's supply, we have a day's supply. And in some price ranges, maybe an hour's supply. It's just a really tight market. As you can see, Hayes has been much higher than average for a number of years, but over the past 2 years, that has just plummeted. And so as home sales increased from 2018 through 2020, we've whittled away that inventory, and now you're sitting at a point where you're at about a 3-month supply, which is much, much lower and what we would generally consider to be a seller's market. As you would expect, when you have strong demand and tight inventories, you should expect to see home prices appreciating. Now this number is the median sale price, which is not a perfect measure of underlying home price appreciation. The median price is the price at which half of the homes sold for a higher price, half of the homes sold at a lower price. And over long periods of time, that really does show underlying home price appreciation. But in the short term, it can get skewed by which segment of the market is selling well at a given point in time. If low-end homes are selling particularly fast and lots of them are selling, you could see the median sale price go down just because there's a lot of activity down there, even as every individual home is appreciating in value. And so one of the questions we'll have for our panelists is what they see as being true underlying home price appreciation in the local Hayes area. I do have copies of our overall forecast for the state of Kansas. I'm not going to go through the details of that. At your table, you have a copy of the the Ellis County Housing Outlook, which gives details about what's going on in Ellis County. There are more copies of those up on this front table. And in addition, we have copies of the large market forecasts that we have for each of the major markets across the state. And you are welcome to take those if you like. We encourage you to take them with you and make use of them as you see fit. And so with that, I'm going to grab my bottle of water here. So now I have my water. And I'd like to invite our panelists up. We have 2 wonderful panelists here to talk about the local housing market. Tim Cossaart, did I get that right, Tim, in the pronunciation? Tim has been a licensed real estate agent since 2013 and is currently the broker at Remax Pro here in Hayes. He holds the CRS designation, which is a prestigious designation, a certified residential specialist, that's what that stands for, correct? And is active in the Hayes Board of Realtors. He was president back in 2019, and he's also the past recipient of the Hayes Board's Realtor of the Year Award and the Distinguished Service Award. So please welcome Tim. And then we also have with us Rob Readle. Rob, right? You go by Rob, right?
Or Robert.
Rob or Robert. He's president of the Hayes Board of Realtor and the owner and managing broker of Coldwell Banker Executive Realty in Hayes. Rob went to Fort Hays State University, where he's earned his Bachelor of Business Administration degree in accounting, and he also works as a mortgage. He has his mortgage lending license, so he can tell us a little bit about that side of things as well. So please welcome Robert Readle. And come, we have a chair for you. So thank you both so much for joining us here today. I wanted to start by just asking you about that home sales. We said that home sales activity here this year has been down. Do you think that that's reflecting a decline in demand in the local market? Or is that more a reflection of the lack of inventory, the tight inventories? And so, Robert, we can start with you because you're closest to.
I do think it's a little bit of a combination of both. Demand has waned a little bit, and I truly think it's just because of the tailing off of the direct cash payments. That really made a lot of buyers come into the market when they unexpectedly had enough money for a down payment on one of the low down payment programs. And so now that those programs have tailed off, I do think that has reduced demand a little bit. But the majority, I think, of our reduction in unit production has come as a result of very, very low supplies.
Very good. Tim?
Yeah, and I would echo exactly what Robert said. Obviously, in the day-to-day activities, kind of gives you a feel for what's really going on in the market. When a house comes on the market, you might get 5 to 10 phone calls from, buyers that are ready to buy that particular house, and if you don't act, it's too late.
How fast are those really attractive homes selling? I mean, there's obviously not every home is going to sell quickly, and people need to understand averages are just averages, and there's variation. But if it's an attractive home, priced right, in the right neighborhood, how fast would you expect it to sell right now?
If it's priced correctly, has no major issues with the property, it'll be gone probably the same day, if not the very next morning.
When you mentioned hours of supply, we're seeing that on occasion. If it's in the right price range, and like you said, it doesn't need repairs, it's the right home, hours of supply of those kind of houses.
Well, that leads right into my next question, which is, with the tight inventories, it does mean that buyers have to move quickly and they have to be prepared. How are your buyers responding to the tight inventories in the market and what's been going on with this seller's market?
I've seen a little bit of what I'm going to call buyer's fatigue. They're getting worn out with trying to get into a house and see it before it's gone, or making an offer and not being the best offer. There's a lot of folks, and it's slowed up a little bit, but over the summer people were paying well over list price. Some were going and foregoing any kind of inspections. Those are not things that I necessarily agree upon. But at the end of the day, as long as that buyer is comfortable with that, that's their choice. We do want to provide them all the information. I encourage everybody to have a home inspection because I think it's something you should have done. But that fatigue is starting to wear on people, and I think we'll see some of them kind of just wait until we see more on the market.
But if you do say, I'm going to have the home inspection, one thing you could do in your offer is you could limit what would be the types of things that if found you'd say, oh, okay, so it needs some caulking around the windows. I'm not going to make that cause the deal to fall about. And that might help you be successful.
Absolutely.
So,
yeah, some other strategies. A lot of people are using bridge loans, which wasn't particularly prevalent over the last 5 years or so. A lot of
and explain for people who may not know what a bridge loan is.
So a typical buyer needs to sell the home that they currently own, and rather than wait for that to sell and then achieve new financing on the home they're purchasing, they may go get a loan that covers both of those properties as collateral, carry 2 payments for a short period, and then in the time that it takes the other one to sell, that would pay off the bridge note, and then you'd have permanent financing on the new property. So that's one strategy buyers are using that we haven't seen a whole lot of over the last 5 years. It happens here and there. Probably the more, normal strategy, a lot of buyers used to put a house under contract contingent on their selling, would then immediately list the property, and then under a normal period of marketing, once that sells, then they would consummate the transaction on the one they were buying. Now we're advising a lot of our buyers, if you're going to be a buyer in this market, you need to take care of your selling side of the transaction now. You get to dictate the terms as a seller, put it on the market. And one of those terms can be, I'll sell you this house, but you're going to wait until I find the one I want to find. And so it kind of flips the sequence of events, but it's another thing that we're seeing a lot more in the market here that probably wasn't very normal over the last 5 years.
And of course, most of us need a mortgage loan in order to buy a house. There are some of us who have cash, but not a lot. Can you explain a little bit the difference between just going and getting pre-qualified for a loan versus actually getting pre-approved? And is that something that's common right now in the market, and how does that impact your offer as you make an offer?
Yeah, it's not just common, it's absolutely mandatory at this point. You can't be showing up without showing how you're going to actually do the transaction. So even if you are a cash buyer, a lot of us are asking for proof of funds or a letter from your banker saying that they have the resources available to go through that. And then if you are using financing, a pre-approval letter is preferred. The difference between the pre-qualification and the pre-approval, the pre-qualification is typically a pull of credit and then relying on assurances made by the borrower, where a pre-approval is actually checking the documentation and collecting that stuff before you issue the letter that essentially says you've vetted everything that they've given them as the assumptions on the application.
Very good. And you're agreeing that pre-approvals are just essential if you want to be successful as a buyer?
Absolutely. It's, you have to have that to prove, because you're usually in a multiple offer situation. So you want to make sure that you're putting your best foot forward, whether that be a pre-approval letter, proof of cash, whatever that is. You want to make sure that when you get that offer in front of those sellers, that if you're competing with A and B on the other side, that you look better than them, whether that would be the lending side of stuff, the inspection side of stuff, anything to put yourself in a better situation.
So how is using some sort of government-backed loan affecting the offer situation, whether it's an FHA loan or a VA loan or a Farmers Home Administration, whatever it may be? How is that affected as a buyer? Is that impacting your ability to win the bidding war if you run into that?
Absolutely, and when Tim talks about buyer fatigue, I think that is usually the source of some of that buyer fatigue, that you go through all of the work to get the pre-approval. When you're using a government-backed loan, it's typically a little more rigorous. And so after going through all of those exercises and submitting what was a list price offer or something, then getting beat out, and sometimes it's not even always the highest offer. It could be the quote-unquote best offer. Some may be willing to take less if it's a cash deal and there's no contingency. And so somebody that went through all of those exercises to get that pre-approval and then show up with a government-backed loan may still end up losing the deal, even if they came in at the highest number. So yeah, government-backed loans do affect the appeal of the offer.
Very good. Well, let me take a moment here to just say, if at any point we talk about anything and there's a follow-up question that you want to have, please jump in. This is fun to have as a conversation. And so, anybody have a question about that issue or anecdotes? Yes, right over here.
Not about that particular issue, but with it being a seller's market and homes moving quickly and demanding higher prices, how are appraisals keeping up? And how does that affect, the whole situation? I mean, obviously, if there's financing involved, the appraisal has to at least come in at the contract sales price, or there's issues.
Yeah, I would say early on in the cycle, early last year, we had issues because the real world transactions were outpacing what the historical evidence that appraisers were using would substantiate.
It's caught up now.
I feel like it's caught up now, and I mean, you always have some hits and misses, but we haven't had any significant appraisal issues. We haven't experienced it. You always have a few here and there, but it hasn't been huge misses like it was early in the 2020 season.
And I'm going to put Earl on the spot here because we have Earl Wirtz with us here, who is an appraiser, also a realtor. And so Earl, how have you been dealing with that and finding the comps in order to justify some of the sale prices that you're seeing in those situations?
It's been difficult. Just finished one over in Ellis, and it did not come into the sale price. The market down there, in fact, on your September report, prices in Ellis are lower in September than they were a year ago, so that's carried through. In Hayes, I haven't had a lot of difficulty with appraisals coming in close to the sale price, but there's quite a bit of difference in Ellis.
Yeah, so if you couldn't hear in the back because he was facing this direction, he said that Generally speaking, he hasn't had a problem in Hayes because you've seen enough transactions at prices to do that. But in some other communities, and he gave Ellis as an example, they actually have sale prices that have been down over the past year, and so then he had an appraisal recently that didn't come in. So that brings up a really good point, which is that every market is local. And so that can even be true within a city. And so even if on average prices are appreciating in Hayes, that doesn't mean every home has. Which I guess brings us to that question of what has been happening with home prices. Is the increase in median sale price a composition effect, or is it reflecting underlying appreciation of homes in this area?
From what I've seen, there is an appreciation of homes. A couple examples, I know I've recently shown some houses that were just sold a year and a half ago. They're back on the market for $50,000 more than they had sold for previously, with nothing or minimal changes to the property. More than likely, those will probably appraise it that number now. So yes, I do see that our valuations are definitely coming up. I don't know that we can sustain that long term. I think we'll see it drop as the inventory level kind of falters back to where it should be. But it definitely is higher now than it has been.
I agree. And Hayes has a limited amount of data, and so I think median is the best measurement in our market. Averages can really be skewed when we only have so many sales and one of them happens to be a big one, or we have several very small ones come in a given period. So I think median is the measurement to watch for that kind of data, and I think it holds true. We have been seeing appreciation.
Very good. Well, of course, one of the ways you can deal with a lack of inventory is to build new homes and to add inventory that way. So tell us about new home construction projects that have been going on in the region, and do you foresee that being able to help resolve some inventory issues in the near term or the medium term?
I don't see it being a quick solution. We've had a few developments, a new one being put on by Grow Hayes, using the RHID mechanism to fund the development. But
RHID, just make sure everybody knows.
Rural Housing Incentive District.
Rural Housing Incentive District.
Yeah, so it's a mechanism that hasn't been used locally here. It's been around. It's been available statewide for about 10 years now. So it's a new way of doing it, but it's still a drop in the bucket compared to the actual demand that's out there. We had a local savings and loan institution that was doing a lot of development over the last 10-15 years, and they really don't have anything teed up to keep developing out. So I don't see construction being a big solution to the supply issues, at least in the short term.
Tim?
And I would agree with that. There are some lots out there currently available for sale that somebody could go buy and build on, and they're not outrageously priced. Specifically in the tall grass edition, those lots are not moving quickly for whatever reason. People just are not, building over there right now. If you look in the 45th Street edition, most of that is purchased and either built on or not going to be available for sale. So there's a little bit of a limited supply there. Obviously, the workforce development east of the hospital, I'm excited to see how that comes up and if that impacts availability of homes on the market as well. But I would agree with Robert. I don't think from a big picture we're going to see a huge drastic change.
In some of the larger markets across the state, Wichita in particular, for a lot of years as inventories were being whittled down, and you saw that they were been low for a long time in larger markets, we weren't seeing increases in new home construction. And part of what happened is that construction costs had gone up so much over the past decade, and existing home prices hadn't really caught up. And so even though there was room to build and need to build, it just wasn't, buyers didn't find it to be a good value to buy a new home. And so I guess my question is that kind of what you're seeing happening in Hayes now? You've got some lots that are available, they could build, but home buyers, even though it's really tight inventories and they're a little bit frustrated, they're not giving up and saying, okay, I'm gonna pay a little bit of a premium to go build. Or is it something different? Is it lack of labor and other issues?
I think honestly it's kind of a combination. I mean, obviously we do have higher pricing, so that same house 2 years ago to build is now going to be more expensive. So that price is gonna come up, and maybe that's eliminated that buying power, and they can no longer afford to build, is where they wanna go back and buy something. You know, when you look at some of the homes on the market versus a new home, there's really not a huge difference in pricing for the price per square foot. So if you wanna build a new home, you can usually get that for not much more than buying a home that's been on the, built for 10, 15 years. I don't, as those prices change, I think we will see more people build, but I don't know that we're ever gonna go back to where we were.
I think Hayes has been unique in that regard for quite some time, in that you could build a house for the same amount that you could buy one, and maybe even come out ahead. Of course, with the supply chain issues and the materials prices, that may have been a little more challenging over the last year. But at the same time, you can build one for about the same price as you can buy one right now.
Yes, question.
And I have to agree with that. So, and Tim knows my history a little bit. I lived in a house for about 15 years with my wife and I. We actually did an addition to it, put in about $70,000 into it, sold it, was enough to justify building a new home, built a new home with the money we made on that, turned around after 6 years, sold out and built another one, okay?
You yourself are easing the inventory issues.
As best I can.
Yeah.
So, but you're absolutely correct. So the new price home that we could build for compared to what I could go buy one for, then I turn around and I need to take that older home and update it. I'm gonna throw in another 50 to 80,000, whatever it took. So yeah, in our scenario, it was much better for us to actually build a new home than to turn around and buy a used one and update it.
Any other comments or questions about that new home construction? Are you seeing a lot of remodeling activity going on in the local community? I see a nod, a head nodding here. Is that, anybody have a story they want to tell? Okay. Well, yes.
I would just say from our perspective, we have underbuilt, you made the comment about the larger communities. We have not met the demand for new home construction for quite some time. And that has contributed significantly to this under inventory problem that we have. And the only way you really add inventory to a market is to build it. And if you have not done so for a number of years, you're gonna play this catch-up game for a long time. And it's, unfortunately, you can't build things quickly. I mean, it takes time to replenish that inventory. And I think that's the situation we find ourselves in to a certain extent here, is this, having not met the demand for quite some time, we've got a lot of catching up to do.
Right. One thing that is an issue throughout most of Kansas is the issue of what we call workforce housing, is kind of the phrase that we use now we have opportunities, maybe employers are interested in coming, but if they bring in, 100 new jobs, where will the people who are going to work in those jobs live? And I'm kind of making an editorial comment here on the side with that, is that so often we focus our efforts with that of, okay, how do we build some subsidized housing to accommodate that, when sometimes the ordinary course of, the reason you have less of those issues in bigger markets is you have continual new inventory being built and added to the market, which allows the existing housing stock to kind of filter and become a more affordable option for people who may have incomes that are at the, not above the median income, but below the median income. So, well, I said the Mortgage Bankers Association is forecasting that rates will go up maybe about a full percentage point over the course of the next year. And you have to take those forecasts with a grain of salt. But if that's the case, going from 3% to 4% is a 33% increase in mortgage rates. I mean, it's still 4%, but that's a big jump. How would that affect your buyers in the local market, or would it?
It'll affect, I think it'll have a big effect. Here recently, a lot of what we've been seeing is maybe somebody owns a house for $200,000, their mortgage is 3 or 4 years old, so it's in the 4s, and they're looking at the market now and saying, I could go buy a $280,000 house at today's rates and my payment stays the same. And so we are seeing upward pressure in the market, in the price structure, because rates have been declining continually. I think if that trend were to reverse, it's going to take those buyers out of the market. They're just going to decide to stay where they're at. And one of the driving factors that has been why that would determine why they're in the market has been the whole change of working at home. I can't tell you how important home offices have been to my buyers here lately, which it was always about bedroom count, bathroom count, and now it's, especially with who I have on the table right now, it's all about workspace at home. So you combine that need with the current environment, the way rates have acted over the last year or two, and it's made them into buyers where they otherwise wouldn't have been. And if that were to reverse, I don't know. I think they'd probably just cope with what they have.
Okay?
Yeah, I see some of that as well. And let's be honest, 4% is still a great rate compared to where, a lot of people probably in this room got their first home for an interest rate. But we're so used to that lower interest rate now that 4% sounds high, which is really not terrible. The buying power, as Robert alluded to, I think is going to be prevalent there. And I think so much that kind of feeds together with what that median list price, how that changes. If that median list price stays the same and we go to 4%, we're going to probably see less people looking to buy. If we see that price drop a little bit and the interest rates go up, that buying power equals out a little bit. So then you are allowed to get back in the market and look for something.
Very good. Well, we still have a few minutes left for some additional questions. So any other questions, things we haven't talked about the housing market, observations? Yes?
It's kind of off a little bit, but how many buyers do you guys currently have that are outside the Hayes area looking to come in?
A lot. In any given month, we have a lot of people, especially from the Front Range. We're seeing a lot come off of the Front Range now because they were trapped for a long time. With the meltdown, there were a lot of people on the Front Range that had maybe bought in at 500, got stuck at 300 and had to wait it out until it got back. Well, now the prices have recovered enough out there that they can cash out, sell their house, move here and buy their homes cash, have no debt, and get out of the city. And so we're seeing that a lot in our office.
And to kind of further expand on that, I see there's some retired folks that are coming to be close to family. I talked to a gentleman yesterday that's going to want to look for a house for his student at the Fort Hayes. So, and that's continual. We've seen that year after year after year. So there are people from outside the area looking to purchase here. It's not just the locals. We talk about each city being a little different and each market being a little different. As prices have changed, like in Ellis and Victoria, I don't see at least as much people willing to live in those communities and drive back and forth as they used to. They now want to be in Hayes, and the pricing has changed enough to where it's better for them to be in Hayes.
Jeremy, you have a question.
So on that, what's the price sensitivity of someone out of town versus, and particularly out of state, versus someone local? And does that tell you something about your market?
Depends on where they're coming from.
Tell me.
We'll have buyers move here from Kansas City and Wichita areas, and they're sticker shock. Mainly because our median income does not match up to our median home price, the same ratio that it does in those areas. You have people come from out west, and they love how cheap things are. If they're coming from Colorado, Arizona, California, they snicker at the prices. So, we definitely have our own little flavor of things, and depending on where people are coming from, there's some adjustment that has to happen there.
Does that tell you something about your own housing prices in the market? I mean, if you're seeing other people not batting an eye, does that tell you something about the ability for prices to be sticky or not?
Compared to our peer communities, ours are high. It's very high, and we've recognized that. We need to build more houses. There's no doubt.
Yes?
What is the average age of home on the inventory right now?
Average age of home, so how
Days
long
on-
has typical
days on-
home been on the market?
How old is the actual?
Oh, how old is the structure?
I wouldn't be able to quote that off the top of my head, but
Probably closer to 40.
yeah,
I was gonna
probably.
say, there's a lot of older homes out there right now on the market. There obviously are some that are brand new, but yeah, I would guess 1930, 1940 is probably an average age.
Question?
Well, just another, I guess it is a question. And, I've been in Hayes now since about 80, right? And it always has been that way where the prices of the homes in Hayes have just been higher than what they should be compared to what people make. Is there a justification? Is it really the inventory? What justifies the fact that our homes here are so much more expensive than they are in Wichita or large places?
Well, let me give my answer first. I'll give my answer. It's because Hayes is the most awesome place to
Yeah.
be. And I say that a little facetiously, but sometimes that's just not altogether wrong. Is if it just is a place people want to be,
Right.
it justifies prices that can't be supported in other places. Errol?
Well, I think, one of the things is that we have guys who just build a custom home and sell it and then build another one, where you go to Kansas City or Wichita, and I've talked to builders in Kansas City, they're gonna build 20 houses and they're gonna get semi-loads of material in, and so their cost to produce that home is here, and our cost is here, so obviously we're gonna have higher priced homes.
Other questions?
I just wanna make one statement.
Sure, go
Talking
ahead,
about
Errol.
Real estate, I'm on the real estate commission. And our meeting Monday, we have now over 17,000 licensed realtors in Kansas, and that's the highest in the history of the Kansas Real Estate Commission.
So over 17,000 realtors in Kansas now, which is the highest number that we've ever had. So that does tend to happen. We tend to see, and when the market's booming, people say, "I want to get into real estate," and then when things get tough, we see who really has the ability to stick it out. It's a tough profession. So, well, do you have any final comments since we're standing in the way of lunch?
I don't.
I'm never
see-
gonna stand in the way
Yeah.
of lunch.
Well, please join me in thanking Tim and Robert for